Well, thank you everyone for joining us on today's webinar. It's 11:45, so we're going to get underway without further ado. I hope everyone can hear me out there. I'm sure they can. So today's webinar is going to be joined by Cameron Duncan. Cameron's our co-head of income strategies at Shaw and Partners. He runs portfolios around over $1 billion in the hybrid space. Been doing it for a very long time, so I'm really thankful to have a good mate and the co-head of our income strategies desk on the call today.
And both very handsome. Really
sorry, mate. Very handsome indeed. So before we crack on, I'm just going to give you a quick overview of what we'll cover today. So it's just about hybrids and what are hybrids initially. So sorry if we're repeating information that people are right across already, but we'll just give a quick summation of what they are and why companies issue them. The components of hybrid pricing, so why they price the way they are, and how do we come up with return expectations on hybrids. Some key ideas. Everyone loves an idea of what we're doing here and now, so we're going to touch on a few key ideas in the hybrid space that people can potentially go and look at for their own portfolios. Constructing a well-balanced hybrid portfolios, and then just looking at the market generally in 2023. So I think that's going to pretty much give a really good overview of hybrids. Before I begin, just a quick disclaimer on the screen there. Any advice provided today is of a general nature only, and you should consult a financial professional before taking any information on board. General information only. Just a quick overview of the Market Matters investment team. I lead the portfolio management function at Market Matters. We've got some really well-credentialed guys on the investment team. Harrison Watt is the portfolio manager on the emerging companies portfolio, and we've got Sean Hickman, who heads up our research lead function. Then I'm joined with Peter Winty and Peter White on our investment committee. In terms of how Market Matters utilises hybrids, so we have an active income portfolio that is listed on the website. It's also open for investment. It combines hybrids with equities and other income securities listed on the ASX, bond funds, things like the Metrics Credit Fund, and a bunch of other things. At the moment, we've got 24% of the portfolio in hybrids. That's been pretty static over the past 12 months or so. The returns of the portfolio on the screen there, it's been going for nearly 5 years now, and it's been delivering 8% per annum. So it's a good blend of equities, hybrids, and other debt instruments. So really suits those investors out there targeting income, but with lower volatility in terms of their returns. And that's, I guess, one of the things, Cam, that hybrids can deliver. So they can deliver really strong yield, but with lower volatility.
Absolutely.
Let's start with what a hybrid is first, and how they come to deliver that sort of lower volatility, higher income type returns.
Yeah, no, thanks, James. Look, actually, the first thing I'll probably start with, and thanks for joining us, everyone, today, is that just talking about the word hybrid really is just a generic term that means something has debt-like and equity-like features. So what we're going to focus on today are more bank hybrids, but corporates do issue hybrids too. They often do them for different reasons. They sometimes do it to get equity credit from the rating agencies, which sounds a bit complex, but it basically means it helps them with their gearing. They can go and issue a hybrid, and 50% of the value of that issue is counted as equity, which makes their gearing effectively lower from a rating agency perspective. There's not too many of those out there, though, at this point in time, and certainly none listed at the moment. There used to be a Crown note, but that's been called.
We held a Crown note in the income portfolio. In terms of so hybrid is a combination of debt and equity, because it's got some equity in it.
Yes.
Obviously, it has some equity-like characteristics and return. Just on the screen in front of everyone is what we call the capital structure of a bank, and this is what we're going to focus on today in terms of tier one bank hybrids. They're the most dominant type security on the Australian market, and what we all care about. So talk to this.
Okay, so looking at that slide up there, the first thing you've got to understand is that you kind of draw a line between the bottom three and the top three boxes there. So the bottom three are effectively capital of the bank. So above that, the bank's got to fund itself via various means to support its main activities, which of course is mortgage lending and some commercial lending and so forth, but certainly mortgage lending dominates in relation to the four major banks. What the regulator requires is that banks issue capital against some of those lending activities. So if the banks didn't have to do that, they'd go and raise all their funds via term deposits and senior debt because it's cheaper. But because there's equity-like features to some of these capital securities, that suits the regulator in terms of having a buffer for when there's stormy weather.
That's the key word. So capital, when Cam's talking about capital, it's about having this buffer zone on a bank balance sheet to withstand shocks to the system and the like.
Exactly right. Now, the other line I would draw there, though, is actually a line above equity and everything else. And the reason for that is that they're really, this banks have a lot of equity on their balance sheet, obviously. That's the first line of defence for, any write-downs or reduction in profitability, etc., or any macro factors that impact on that basis. So back in about 2015, and this is one of the reasons why we really like hybrids and subdebt to a certain extent too, is that the regulators decided, post GFC, that the banks were inadequately capitalised. So they made the four majors and Macquarie go and issue circa north of 20 billion more equity capital. So the effect of that was it made hybrids and subdebt actually safer, essentially.
Increases the buffer underneath.
That's right.
Yeah.
But fundamentally, the characteristics haven't changed particularly. So post GFC, 2012, beginning of 2013, these new Basel III type securities. They did a big conference in Basel in Switzerland, and they came up with this new structure. So effectively, when you're talking about a hybrid, a typical structure might be a 7-year security. And when I say 7-year, it might have a 5-year optional call date. Now, in 95% of cases, hybrids are called at the call date. If they are not to be called, and that call is subject to APRA approval, if they're not to be called, they typically then stay out there for another 2 years, and then they would mandatorily convert into $100 worth of shares. So, or $101 actually. But that scenario has never arisen. But therein lies the buffer-like characteristic, if you like. So, look, one of the key things, though, that I would like to mention about hybrids is that they've got what's called a distribution stopper. So, and that's why I draw a line between equity and everything above it. So, in the event that any amount of a ordinary dividend is being paid, the full distribution, as we call it on the hybrid, must be paid. Now, sorry, did you want to?
No, so I'm just so if banks are going to pay a dividend on their shares, any dividend on their shares, they have to pay the full distribution on the hybrid's equity share.
So even if the bank dividend gets reduced to 1 cent, the full hybrid dividend has to be paid. So it is still regarded and referred to as discretionary, but you've got that dividend stopper, which is very powerful. Now, the other thing, of course, is, and anecdotally, we saw in 2020 when the pandemic hit, ANZ and Westpac defer and omit an interim dividend.
Yeah.
And but nevertheless, the hybrids all continue to pay their full distribution.
Yeah, that's an important.
That's the only test case.
That's an important test.
Really. It hasn't happened at any other time that I'm aware of. Certainly not back to post 1990.
Yeah.
So that's your hybrids. Subordinated debt differs a little bit. It's got equity-like characteristics too, but it's referred to often as Tier 2. Hybrids are referred to as additional Tier 1. Tier 2 subordinated debt pays a coupon, so it's a bond, but that coupon can be deferred. So it doesn't have a mandatory conversion like hybrids. It's got a hard maturity date, but typically these things are issued in the form of a 10 non-call 5, and what that means is it's got a 5-year call date, which is typically what happens. It's typically called at the call date, but it doesn't have to be. And if it's not, then it'll go through to the maturity date.
So
so you'll get a lower rate of return owning sub-debt than you will hybrids, effectively.
They're effectively more vanilla securities. There's not as many sort of complexities in them. And I think the other important thing is that the hybrids are considered permanent capital, if you like, so they can go onto the bank's balance sheet as capital if those conditions are met and they continue. Whereas subordinated debt is not permanent capital. It always needs to be paid back to the debt holders. Let's move on and
sorry, one other key thing too is the hybrids are franked, and in the case of the major banks, sort of 70 to 100% franked. And subordinated debt is never franked.
Yep. Okay. So nor a bond. So the debt-like characteristics of sub debt and senior debt mean that there's no franking involved. There's franking in the hybrids, but different hybrids have different levels of franking. So Macquarie's got a lower level of franking than the major banks. They frank at the same level as they frank their underlying shares.
That's exactly right.
On the screen there is just a quick look at the major bank hybrids: yield to call and margin over swap. So the margin over swap is the black table.
The black
column is your table.
Yep, it's my table indeed. And this is a very important tool that we use, and I know James looks at it daily too, to sort of work out what looks relatively cheap or expensive across the hybrid security curve. So these are all, this particular chart has only got the major bank hybrids on it. And the different maturity in inverted commas, if you like, it's not actually maturity, it's the call, we price it to the call date. Remembering that technically it doesn't have to be called at the call date, but that is normally what happens.
Scorched earth scenario says that they won't, but
so you've always got to point that out to people. Effectively, the margin is the difference between the big number at the top of the orange columns less the swap rate to that call date. Now, the margin is actually a pretty good tool for comparing apples with apples because it's washing out the different swap rates. Swap rates are typically higher as you go further out the curve. Not the case in the US at the moment because they've got an inverse curve, but in Australia we've got a normal curve where the longer you invest for, the more you'll be rewarded for it, given the greater credit risk of investing longer.
Absolutely.
So typically what happens is at call date, when these things come or approach call date, the banks will look to roll these securities. And so they will, they'll market a new issue. Some people will elect to roll, they'll do a new money issue, and then we'll get a new issue that's, longer dated. It'll be, the most recent one is obviously CDAPL, which is at 5.5 years there. That was done only a couple of months ago at a margin of 285. And you can see that's now at, what's that say, 247?
Yeah.
So that's another discussion we'll have. But effectively what we use a chart like this for is to look at the curve, and we like to have a spread of hybrids across the curve to give yourself some diversity and effectively cash being redeemed along the way, different call dates, which is good for people's cash flow matching. But where you've got and those lines through it, by the way, are just lines of best fit. So if you look at the securities that are above the line, they're relatively cheap, i.e. they've got a bigger yield or a bigger margin, and vice versa.
Yep. The other important thing is, on the chart there, you can see that the NABPH 5 years to run, it's got a yield to first call of 6.36%. There was some of these recent issues when we're putting emails out about this, when we're writing about them, we're citing a yield of 7% plus. Why are they now 6.36%? I think it's important to talk to the changing dynamic of forward expectations on rates and how that plays into pricing.
Yeah. Look, one of the things we haven't mentioned is that hybrids are all, not all, but 95% of cases are listed on the ASX. And as we mentioned, they're all franked. So given they're listed, tradable on the ASX, very transparent, you can see the price. Sub-debt, there is one sub-debt piece listed on the ASX, all the rest of them trade over the counter. So, the market, you've got to ring a market maker or another participant and trade them accordingly, typically in bigger parcel sizes. But Yeah, I mean, look, the other thing that's important is that they're all floating rate. So what I mean by that is every quarter, the distribution is adjusted based on when they're issued, there's a fixed interest margin. So that'll be issued on the basis of wherever prevailing credit spreads are at the time.
Yeah. So the 90-day bank bill
which is what it's out to.
Absolutely. Then you've got 90-day bank bill plus a margin, and that's your that's your yield. That's your distribution rate.
That's your distribution rate.
So then, when you're pricing forward securities, because we're not holding 90-day securities.
No, that's right. So what you've got to do then is look at the shape of the swap curve, because you don't actually know what distributions are going to be, what they're going to be going forward. So you've got to use something. You've got to effectively estimate the yield to call. And this is the same across. It's not just a hybrid thing. That's how you value floating rate securities. So what you use is the swap curve to estimate future distributions, and the swap market obviously is telling us where they think rates are going to be at a future point in time.
Bit of move in the swap curve last night.
Yeah,
in the US.
a little bit of movement. It's been bonds have been more volatile than for decades, effectively.
Yeah. But that's a really.
So the swap rates have come down in the past month. The yield to call has diminished a little bit.
Yeah, but they've gone up substantially in the last couple of years. So if I think about our, we utilise hybrids. Obviously the market matters portfolio, but we run, discretionary portfolios here through Shaw. We use a lot of hybrids across our portfolios. I think we've got, 35 million in the Shaw hybrid SMA, and probably another similar amount outside of that. So, from a portfolio management perspective, I can sit here and talk to, clients that we're managing their portfolio and think about how bonds have performed over the last 2 years, which has been pretty, there's been a lot of rhetoric around how tough it has been in the bond market. You hold a hybrid portfolio and you haven't had to make that bet on interest rates.
Correct.
And let's be frank, most people have got their calls on interest rates wrong. It's been, no one really saw the cash rate going from 10 basis points to 300 basis points in such a short amount of time. And now in the last little while, we're saying, well, markets actually got a little bit ahead of themselves. We're now starting to see that repricing is lower. And that's why you see hybrid yields, paying 630 versus, over 700 when they were, a couple of months ago.
Yeah. So, I mean, naturally what happens is, as credit spreads contract, the price of the security goes up, therefore the yield, you're paying a bit more to own it, which reduces your yield to call. So, but as you correctly point out, James, I mean, those investors that have been exposed to fixed rate bonds, particularly longer dated ones, back if you had a bond exposure at sort of, 1%, 2%, I think, obviously Apple and a couple of others issued them at crazy low yields out to 70 years and stuff like that. I mean, those bonds are now trading at, 60, 70 cents on the dollar.
Great for Apple.
So
not so on hold. A good point about moving on into, these are hybrid spreads over time. So this gives us a feel for where the market's moved at different increments in time. So talk to that chart, Cam, because I think it's a really good one in terms of showing where we're at right now.
Yeah, no, look, it is. It's and apologies, there's a few sort of colours that are not that different there, but our colleagues colourblind.
The hybrid team is with no graphic designer on the no graphic designer on the team.
That's right. But probably the thing to focus on there is, if you look down the bottom, the black column is last night's close, where margins are. The next one along is a week ago. So you can see in some cases, like if you look at the shorter dated, look at ANZ, ANZPG, you can see that, or even if you go to a month ago, you can see that the spreads have contracted significantly. Yeah. So this is partly a function of what James was talking about. Rates have come off again, but more to the point, credit spreads, i.e. the risk premium that the market is placing on the default risk on credit.
This is the iTraxx credit default swap chart, which basically is a really good measure of risk and how the market's pricing it. Yeah, you can see how much it's pulled back. Yeah,
I mean, credit default swaps are effectively insurance against senior debt defaults, so they tend to be more volatile than true credit spreads. But it's very much a leading indicator a lot of the time, and I mean, you can see the big drop there in
The cost of insuring
credit default swaps, yeah. So, so I think, there's a couple of other dynamics, James, that are probably worth mentioning in relation to the way these margins have come in. And you can see a year ago, sorry, if you go to the right-hand side, the blue column that you can actually see, that's where margins were. And then you had that increase in margins or risk premium, which was basically when we started going through this tightening cycle.
Yeah.
So, the market became very concerned at the pace of the increase in interest rates, and that made the market perceive that there was more risk associated with owning any security.
So that's a good question. It's one we've had, the name escapes me, but earlier on, it was actually Sarah asked about the influence of interest rates on hybrids. So you touched there about the pace of interest rate hikes. So there's a couple of things to think about there. There's obviously what that does to the underlying asset quality of banks. So will they go through a period of stress? So let's put that thing to one side. But how does it, when cash rates move at 10 basis points and they move to 300, if a hybrid's paying 300 over cash, that's 30 times the cash rate.
Yep.
When it's now paying, when cash rate's at 300 and the margin's 300, it's double the cash rate. So how does it?
You're getting a much higher yield in essence. But the interesting thing about it is, and this is a function of how floating rate securities work. Whilst they look more attractive now in terms of yield, they were attractive even back when yields were low too, because when rates go up, if you're on a fixed rate security, you're stuck on that yield till maturity. So it's like an opportunity cost thing. If rates go up in a floating rate security, you move up with them.
Yeah.
So that the capital price of the security tends not to be that volatile. It moves around a bit with credit spreads, but not really interest rates, because you're only ever locked in for a quarterly period. So if you had the view that rates were going up, you were much better off being in floaters. If you're in a fixed rate security, what has to happen with that is rates go up. For a new marginal buyer to come in and buy that fixed rate security, it's got to be competitive with the new paper being issued that might have gone from 1% to 4%. So the way its yield goes up is the price of it goes down. These floating rate don't have that dynamic because they reprice every quarter.
So this is so to give you an idea on how they the movement in price of the underlying hybrid. So on the screen there, you've got you can't see the end because my face is there. I think I'm trying to move that. Anyway, this security, I think you guys can see it on your side that it's trading around $100 a security, but it's been as high as 102 and it's been as low as $94. So that's obviously changing sentiment around risk dynamics and all those things. That's the ANZ PJ on the chart there.
Okay, yeah.
The ANZ PJ. So this is a longer dated security to give you an idea around the ANZ PJ. It's got 6.2 years to run. It's got a margin at the moment of 2.52%. So it gives you an all-in yield to call of about 6.5% from memory.
Yeah. So given how far back that's going, I'm assuming
that's only going to
it's been rolled from the previous security, hasn't it?
This is this is only going back to March of this year.
Oh, sorry. Okay.
Yeah.
Right.
So earlier on this
year.
Yeah.
Got it. Sorry.
Yeah.
Not very good with dates. So yeah, I mean, you can see that. I mean, obviously the price went down.
So that's June, right?
Yeah.
So that's June of this June of this year.
Yeah.
Talk to what happened there.
So
this was
it was a bit of a
few nuances.
Unusual event, really. I mean, it's a little bit like a mini sort of GFC response in the sense that people just panicked when interest rates were starting to go up, and they started to sell everything. Now, one of the features of this, because it's listed, if people happen to get margin called in equities or just need to raise cash, this is a pretty easy way to do it.
It's a big influence. It's a huge influence.
So sometimes you can get outsized volatility, and by the way, that move, over the past, say, 20 years would be in the top probably 4 or 5 moves.
Yeah.
So you get these situations, but us sitting here as, sort of professional portfolio managers, I mean, in one sense, we don't like it when this happens because, people invest in these things for regular income. They don't really sort of expect.
But that doesn't change that.
It doesn't change. You're 100% right.
So you're talking about, and I go back to the...
and it provides opportunity for any new money that happens to come through.
It does. You've got to take it's an important consideration. So to get an increase or uplift in return, you take on risk, and this is this graphically shows the risk that you take on. So can I withstand a 6% drawdown in this security to get a 6.5–7% yield over time? I'm pretty comfortable with that, but each individual investor will have their own views around what risk they're willing to take on. If I think about a portfolio that holds equities, some debt instruments, 25% in hybrids as we do, a portfolio like that's going to have about 50% of the underlying volatility of the market, still yield the same as the market. It'll have a little bit less capital upside, but we're trying to deliver sort of 50% lower drawdowns, but still retain 70% of the upside in the market. And that's sort of the characteristics of a portfolio that you want to create in an ideal world. Right. And I think hybrids can do that, but you've got to understand that there is some capital risk in there if you're forced to sell at the wrong time.
And then you can see by that movement too. I mean, that's sort of a circa 5.7% move to that bottom from 100, call it 100 down to actually started at 102, but circa 5–6% move. But look how short a period of time it stayed there. And that has happened on numerous occasions. When the pandemic hit in 2020,
here's a CBA PG, so that goes back into what happened in the pandemic.
So that was an even more extreme example. In fact, when the pandemic hit, that was more extreme than the GFC. The response, people just did not know what was going to happen. And the one thing they decided was, well, some investors, not all obviously, in fact, most of our investors, we told them, do not sell, just stay there. But effectively what happened was that people wanted to go back to cash because they were uncertain, they were fearful. So,
that's a big sign of fear there, right? So this is a CBA PG, which is a shorter dated note. It's now got less than 3 years. We've got about 2.3 years to run. So it's been around a while. It'll be less volatile now because it's got less time to go before first call. So that's another important thing. If you want to reduce the risk, the capital risk in a security, you go shorter dated.
Yes, you do, because you've got, the assumption is that you'll, or the normal situation is that you will be called at the call date. And even if you're not, then it might go 2 years hence. But effectively, it's the effect called pull to par. So, because you're getting closer to the expected $100 return, the volatility diminishes.
And it's a simple case of there's a shorter window for stuff to go wrong.
Exactly.
So
and you're closer to getting $100 back.
Absolutely. So in terms of that is a big move. So that went from 105 down to $80 $80 of security in CBA, which was obviously a very well capitalised, the most highly capitalised Australian bank. But you see how quickly it snapped back. I know, mate.
You saw it.
Absolutely. I mean, equities, to give you an idea, so that hybrid pullback 20%, call it. I mean, that's in the against an equity market that pulled back 40%.
Yeah.
So while that volatility is uncomfortable, we're still experiencing 50% of the downside in the underlying equity market.
Yeah, no, absolutely. Yeah, it's never as volatile as the equity market. The interesting thing about that was the speed of the rebound.
Yeah, but okay, so this brings up another point around, and this was a question.
We have equities too, obviously.
Yeah, absolutely. But it also brings up the issue around liquidity.
Yeah.
So Brian was asking about the impact of liquidity and watching hybrids in the screen. How do you find dealing in hybrids on a daily basis? You're dealing in large lines. You're not dealing in small parcels.
No.
How do you find the liquidity out there?
Look, I'd call the liquidity variable at times. Frankly, for anyone transacting sort of, sub $1 million parcels, there's plenty of liquidity, certainly in the major bank hybrids. We talk to a lot of institutions and sort of professional players in the market. So there's also, as well as the sort of churn that occurs in the screen, just the day-to-day transaction with bid offer transaction. There's also special crossings and other crossings that go through where we, as a broker, match up the buyer and the seller, and we might just put a bigger parcel. You're allowed to cross those once they're over a certain value at any price. So, there's various ways to skin the cat effectively in terms of liquidity, but the fact that they're listed and everyone can see the price is actually very beneficial. We've seen this. So in that situation, over-the-counter debt for a space of time was not trading at all, or minimal. Some of it was just locked up. It was not trading. These things kept on trading. Now, because they keep on trading, that can exacerbate the volatility a little bit. But what would you rather have? A little bit of extra volatility and still be able to transact, or be told, sorry, there's no market for your security?
I love it. So I'm a big proponent of the listed market. I hate opaqueness. I like seeing how things are pricing, what others are paying for something, what something is, the liquidity in something. I'm a skeptical person.
Yeah.
Getting on the other end of the phone with a bond dealer, I can't see it. You're relying on a fair amount of trust in that relationship. So I'd much rather be transacting in the hybrid space, given the transparency in the market there. Let's move on. So we covered some of these. So we're talking about opportunities in the hybrid space, and these charts actually correspond with a couple of opportunities that you like here and now in terms of security. So these were out of your morning note this morning. So you've got three securities there. So you've got the ANZ PJ, which is greater than 5.5 years. It's got 6.2 years to run. The NAB PH, which is sort of a midterm, it's got 5 years to run. And then you like that was the NAB PH with less than 5 years to run. And then you've got the CBA PG, which is a shorter dated security. So these just screen.
So if you go back to the sort of original chart, let's start at the left-hand side, CBA PG, which is 2.34 years. You can see where that is relatively in terms of the yield to call and the margin. It looks pretty attractive. So we're doing a bucket there out to 3 years, I think it is. And this is, James has just referred to 3 picks. We've got one shorter dated, one in the mid section, and one that's a bit longer dated. So you get that spread of call dates effectively. But you can see the NAB PH is quite stark. I mean, you can see that one, which is 5 years, is sitting quite a bit higher than all its surrounding peer securities. Remembering, of course, all the major banks are rated the same. From a credit rating perspective. So
higher than the Aussie government.
No. So you're comparing apples with apples, but you just, for whatever reason, the vagaries of it being listed, you're getting a superior return on that particular security. So hence we recommend it. If you go out longer, what was my longer dated pick? It was
the ANZ PJ,
because they often change these daily, sometimes not. But that's 6.27 years. So you're basically getting, what's the margin there? 252. You're getting a higher margin there than going all the way out to 7 years from that PI. So on a relative value basis, that looks attractive.
That's it. So just so you can jump onto this. So drop me an email if you do want to receive this daily. So the income team does a note out there looking at these sorts of things, yield to call on a daily basis, the full rate sheet that runs through all the rates of the listed hybrid market. It's so for Market Matters subscribers, you can reach out, simply drop us an email at info@marketmatters.com.au. I'll put you on that list. It'll be coming from Shaw and Partners. But yeah, we can jump on and you can see this on a daily basis and you get a feel for how the market evolves over time. And that's, I think, one of the keys to getting comfortable in a market is seeing how it evolves over time. I've dealt in hybrids for a really long time. To your point about liquidity, we often trade in $1 million lines. We have no real issue with liquidity. Once you get, I'm not here promoting, I'm not on the back of promoting hybrids, in entirety, but they're a great part of a more diversified portfolio, and they can really add to sort of those risk-adjusted the returns that you get out of a portfolio of securities.
Yeah, absolutely. Actually, just it's worth mentioning too, if you go back on the far left, ANZPF, So that's due to be called March next year. You'll notice the margin's actually negative. And that typically happens as you get very close to the call date. So assuming that's called in March, which we expect it to be, the other thing that you've got there is the optionality of the fact that they'll market a new deal and you'll be offered a new hybrid, which will be, 5, 6, 7 years. It depends on the issue. It's got to be at least 5 years to qualify as capital. And if you like the margin, you can elect to reinvest. If you don't, you sit there and all other things equal, you should be called.
Otherwise, you go through a broker and you put a bid in. You often get scaled back because demand is really high. So, typical scale backs can be 50% of bid amount. So, and also now there's this change of regulation around who can bid into broker book builds. It has to be clients of a syndicate broker, getting personal advice from that broker, or sophisticated investors. So there's some anomalies around who can access this now, which is seems pretty unfair to me. And but that's the way it is.
Yeah, the regulators made it a little bit harder for those people that aren't onboarded at some sort of brokerage firm or institutional.
I'm going to get on to, so there was just one final point I wanted to do, and I think you've spoken to this around constructing a hybrid portfolio. So you spoke to having varieties of exposures, so obviously names in there, but also duration. So maturities coming up for first calls over different time frames.
Look, it makes sense to spread your risk across the different banks' names because specific credit events and things occur to each of those names at times.
Ask Westpac. Yeah,
exactly. There's been fines and so forth, and that might have an impact on pricing. Tends not to have much on the hybrids given the amount of capital they hold and the profitability of the major banks. But nevertheless, that's prudent to have that sort of diversity. And likewise, different call dates, they're going to have different volatility characteristics. The longer dated may be more volatile, and it just makes sense to spread your risk effectively.
In terms of Shane's asking here around. And you basically spoke to this, but could you explain why hybrids don't? Could you explain why hybrids that have the same margin, say 3.5, priced differently by the open market? He cites WBCPJ and BOQPG as an example here. The WBCPJ has got is trading at 104.20, mature first call in 2027. It's trading on a margin of 225. Versus Bank of Queensland, the BOQPGs a year later at a margin of 320.
So where you've got two securities, they might even be the same call date that are trading at a different price with the same trading margin. It's usually a function of having a different issue margin. So you might recall when we said these things are issued at primary, so new issuance, depending on where. So like if you're going to issue a 5-year security at the moment, right? Your reference point is NATPH or the securities around it. So it's somewhere between 2.25 and 2.6, right? It's not let's say it's issued at 250.
But normally a new issue is going to have a tiny bit of fat in it. Obviously,
correct.
CBA didn't do it in their most recent issue, but generally speaking, they're going to give 10 to 20 basis points of fat to make it attractive versus the secondary market.
No, you're 100% right, because they're trying to attract new buyers. So it's like any sort of auction, effectively, it's got to be something in it for the investor, and obviously you see that in equity placements and like, done at a discount. So that occurs, and but it really is the main differential is the different interest margin. So if the interest margin's higher in one of those two securities, it's going to tend to trade at a higher price. And you're getting a bigger distribution.
And also in the examples given, Westpac is a high credit quality than Bank of Queensland. Westpac's got a slightly shorter duration. So 2027 first call date, Bank of Queensland's got DEC 2028. So you think about that. So the margins are 320 for Bank of Queensland or 225 for Westpac. Am I getting compensated by another 100 basis points per annum to hold Bank of Queensland? So that's the question you ask yourself. And the other one, he cites the LFSPA, which I think they're the Latitude Capital Notes. So they're a completely different kettle of fish.
Yeah, look, it's an unrated credit. You know, obviously a much smaller market cap and entity. You would expect to get a much higher rate of return for that risk. Simple as that. Effectively what you're talking about.
In my view, that the risk you take on to go into something like that is disproportionate to the return you're getting over and above a tier 1 bank hybrid. Is the way, and so we tend to step away from that. We did have the Crown sub-note in there, which there was a few catalysts that we saw around that that was going to be.
That's almost like a special situation, right?
Exactly right. So there are times we go outside of that, but from a general rule, if you're looking to construct a well-rounded hybrid portfolio, I would certainly stick in the major tier 1 banks.
Yep.
The regionals, yes, the insurers. Things that are regulated, so they've got regulated capital.
Behind
that. Absolutely, someone looking over their shoulder saying you need to raise capital, you need to beef up here, you need to. So that's what that makes me or gives me comfort as an investor.
And we've seen it in
the space.
We've seen sort of when the banks do start their capital starts reducing, or at any point in time, you've got the regulator saying, as we saw when the pandemic hit. You should look to reduce dividends. And as soon as the banks start doing that, they accumulate capital, right?
Yep.
Because they've still got huge earnings. They might even get to the point theoretically where they say, and this is good protection for a hybrid holder, you don't have enough capital, go and raise for equity capital. They might push them to do that. They might tell them to stop.
We've done that in the past.
Stop paying profit share to staff, believe it or not. They've got all these mechanisms at their disposal to make sure that the banks have got enough equity.
And they want this market to work. At the end of the day, they want this market to work. Just a question here on, with government trying to clamp down on franking credits returned to shareholders, where does it stand for hybrid? So,
well, no change at this point. It's still an avenue open to the banks to stream franking effectively. Shareholders don't always love it because they want it all to be streamed their way, but at the end of the day, hybrids are franked, and must be franked at the same level as the ordinary shares. So no change there.
The Labor, I don't
know how they'd be able to really.
So I think what you might be talking about is a change the government's trying to make on large buybacks. The off-market buybacks and the things you can blame Jerry Harvey from Harvey Norman for highlighting the loophole in that. So there's no change around obviously hybrids. Back when Labor were going to the polls at the last election, when Scott Morrison surprisingly got in, and the change of franking credits, that would have had an influence on the hybrid market.
Yeah, look, it did have an influence, and people got concerned. They were talking about not allowing sort of rebates to superannuants and so forth. But what they neglected to sort of understand was that the electorate's a little bit sick of superannuation being tinkered with, point one. And actually franking's working pretty well. I mean, it stops double taxation, right? And the other point is they forgot about charities and so forth, who they wouldn't be getting their rebate that aren't actually taxpayers. And so you're actually introducing double taxation by trying to get rid of it.
It's a great point. We manage a number of Australian charities who utilise hybrids in those portfolios, and they've done particularly well for us over the last 5 years or so. Cam, I'm going to wrap it up there. I'm going to thank you very much for joining us and imparting some of your wisdom in the hybrid space. As I said, you manage over $1 billion in the space. You do it on a daily basis. It's really good to get your insights, from a practical standpoint around the hybrid market. There's a lot written about hybrids, and they can be considered a little bit complex. But we've tried to unearth or uncover some of those myths and through the Market Matters report. So keep reading those. We'll keep following hybrids, and we lean on Cam and his team a lot for the insight that we provide to our Market Matters subscribers. If you do want a daily hybrid report, simply reach out to us. We're happy to put you on that report. If you want a little bit more information on Market Matters, go to visit the website. You can talk to the Market Matters team on the phones provided. You can email the info pipe, or you can even start a chat. There's heaps of ways to get in contact with Market Matters. If you're not subscribing, I think you should. We've got a lot of happy subscribers out there who like our forthright advice around the markets and what we're doing in them. So thanks for joining us. We'll end it there. Bye for now.
Thanks, James.